As you think about public markets over the last 20 years, a lot of people would argue that the alpha has been sucked out by automation, by effectively low cost ETFs. It's just been arbitraged away a lot by technology and by things like Wealthfront and robo advisors. How do you think about what's happened in the public markets, and how does that shape why people should be investing in private markets more?
So, for you actually hit the nail on the head. Last 20 years, we moved from active to passive through automation. So most of us are accessing low cost ETFs, index funds, and mutual funds. That's part of this part of our equation. But that leaves us with no alpha, right? It's generally generating beta in the morning. But broadly speaking, what has happened outside the public markets? Think about private equity funds. So think about Apollo, Blackstone, KKR, Carlyle. They took the first 20 to 30 years of their existence to get to $40 billion of AUM, okay, individually. In the last 10, 12 years since the global financial crisis, they've gone from 40 to 400, 500, 700 billion dollars. Why? Because they're generating returns for their investors. Who are their investors? Sophisticated LPs, pension funds, endowments, nonprofits, sovereign funds. Why are they investing them? Because again, they're driving alpha. Okay. So that's a very, very big phenomenon because they've been successful. And so our thesis is, why should we not have access to that? Okay. And what we have been told is 60-40 is the way to go. Okay. But that was true 40 years ago, not today's environment. Right. So that's one reason. The second reason, Daniel, is that when our parents invested, right, in 80s, 90s, companies to go public really soon. And then they really had their growth after they were public. So think about Apple, HP, IBM, Cisco, Sun, Oracle, Microsoft. Like the name goes on and on. Like they went public so soon. Okay. And so in the 80s and 90s, they had a tremendous run in the stock market, and all of the retail investors, like our parents, benefited from it. But that's not happening in the last 20 years. More companies are staying public. So outside of Salesforce and Facebook and Google and Amazon, there are only few companies that went public that really exploded, right? But a lot of the companies like Airbnb and Zoom and NetSuite, all these companies they stayed private for so long. Uber and like just so many companies. And so I think those two phenomenons are really what's holding just generally a consumer's portfolio back. And we feel that alts is going to drive alpha in the next decade. And so I think that's important for us to make it more accessible, but also educate the consumer that, hey, this should be part of your thinking and part of your portfolio.